Hello and welcome. We appreciate you taking the time to listen to this video where we discuss the 2020 election and what it means for financial markets. We want to acknowledge that the outcome of the election has the potential to impact different aspects pertaining to financial planning, including Social Security and income tax policy. Our goal in this video is to focus on the financial markets and placing the potential outcomes in perspective, rather than trying to predict the outcomes themselves or how they will impact all of the variables. With that being said, the main question we hear often is, what is going to happen to the markets or the economy if Trump or Biden are in office? So we're going to start off with this quote, and we think it's an important quote for a few reasons. But first, let the quote sink in for a second. The first point we want to make with this quote is it's actually not a quote from the current presidential cycle. Rather, it's a quote from the summer of 2016 when it was still candidate Trump. I share this quote with you for the sole purpose of providing perspective. If we go back in time, the prevailing wisdom from the summer and fall of 2016 said that there were two things that were widely expected. One was that Hillary Clinton was going to be our next president. Second, in the chance that Trump did win, our economy and financial markets would suffer because of it, again bringing us back to this quote. Interestingly, and diving in even further, on the morning after President Trump was declared victorious, the futures market plummeted, and we geared up for what we thought might be a long haul. The Wall Street Journal even had an article titled, "Stock Futures Plunge as Donald Trump Posts Surprising Win." Well, that fear didn't even make it through the first day, as the S&P 500 closed with a positive return. The moral of the story is prevailing wisdom can often be wrong. So with the knowledge that prevailing wisdom is often wrong, what can we actually even do about it? Well, one thing we always recommend is not letting your emotions drive your decision-making process. This chart shows how people feel about the economy. Republicans, as shown by the red line, generally felt good about the economy in the early part of the 2000s until their feelings pretty much fell off a cliff. It's expected a lot of these negative feelings had to do with the great financial crisis in 2008, but interestingly, their feelings about the economy barely recovered until 2017. From a presidential cycle standpoint, their feelings coincide with the Obama and Trump presidencies. Opposite, Democrats felt less positive in the early part of the 2000s, but feelings progressed through the Obama years. Is this a coincidence, or are people's feelings about the economy tied to their political beliefs? As this chart runs through early August 2020, you can see the varying feelings about the economy between members of both parties. What's the moral of all of this? Well, we believe, again, you shouldn't let your political leanings impact your financial decisions. Why shouldn't you let your political leanings impact your financial decisions? Well, because if you did, and this goes for members of both parties, you would have dramatically reduced your financial nest egg. As this chart shows, the investors that stayed invested regardless of who was president did phenomenally better than those that invested only under their party president. So let's take a look at this in more detail. Let's start with the fact that the average return for each presidential term in the US going back to 1929 is over 10%. It's a pretty phenomenal number. As an investor, do you care if that 10% is earned whether a Democrat or Republican is in the White House? Overall, whether there's been a Democrat or Republican president, whether it's been a one or two term president, the S&P has been positive most of those terms. Looking at it more closely, there have only been 4 presidential terms where returns were actually negative. As we believe in global diversification, and we know you just aren't invested in the US stock market, we wanted to look outside the US as well, with this chart showing developed international stocks. In doing so, the results are similar to the US, with an average return of almost 9% for each presidential term. What's interesting here is for the MSCI EAFE, which is the index we look at, it's only been negative during terms of Republican presidents. But when we look at emerging markets, there were 2 presidential terms where the returns were negative, but this time both were during a Democratic presidential term. Honestly, our best guess is that in both developed and emerging non-US equity, this is more correlational than causational, meaning that negative returns were experienced for reasons outside of the fact that a Republican or Democrat was president. Of course, one open question could be how the world becomes either more or less connected from a global economic standpoint. Regardless of politics, if you think about the current situation that we're in with COVID, if you've been to the Apple Store, Home Depot, or your local bike shop, it doesn't take long to see how the global supply chain has been impacted. Shifting away from equities, let's look at fixed income. One thing to notice is that the average bond returns have been quite high, averaging 7.1% for each presidential term. It's important to remember that we have seen interest rates drop from the teens in the 1970s to near zero today, and we know prices move inversely from yields. The other item to note is that, unlike equities, there have been no presidential terms over the time periods available that saw negative returns in bonds. One question we hear about is the possibility of corporate taxes increasing in the event of a Democratic sweep of the presidency, Senate, and House. While we are not tax experts, this chart shows how the Tax and Jobs Act of 2017 brought the effective tax rates in the US closer in line with other countries globally. While it's always possible corporate taxes could increase, we don't know for sure if they will, when that happens, or by how much. We also hear all the time that this election just feels different given the current environment with the economic impact from COVID-19, social unrest including the Black Lives Matter movement, and everything else going on. Well, you're right, this time is different. In fact, we would argue the exact circumstances are always different, though the outcomes have been similar. This chart shows us the growth of a dollar from the MSCI World Index over a 50-year time period. You can see all the different events, including high inflation, wars, terrorist attacks, and plain old recessions. And while all of those events feel large and important at the time, if you look at them over a longer time period, the reality has been that they have been blips on the radar. In short, a disciplined investor looks beyond the concerns of today to the long-term growth potential of markets tomorrow. If we pull that time frame out a little bit further and look at it from a presidential party standpoint again, the chart tells the story of a disciplined investor who has done well by staying invested. You may be asking yourself, why is this the case? Well, the reality is that markets are made up of public companies that are required to make decisions that are in the best interest of their shareholders. So whether there are currency crises, changes in tariffs, changes in taxes, or some other event, the leadership of these companies adapt to their environment and do what is best to build capital for their shareholders. So I know there's somebody watching this and saying, I hear you, but I still think I should go to cash until after the election. What's so wrong with that? It's a really good question. Our strong preference is to stay invested rather than to try and time the markets. When you time the markets, you have to be right twice. You have to be right once on the way out of the markets and then again on the way back in. The reality is we don't know anyone who can make those calls consistently. We also know that missing only a few days of strong returns can drastically impact overall performance. If you look at the performance of the S&P 500 index from 1990 through 2019, you can see how different your outcome would be if you simply missed just a few of the best days. Again, these returns can come at any time and may not come together, so you may miss them by being out of the market for just only a little while. It's completely understandable that many of you will have a strong personal view on politics and what may happen as a result of the presidential election. That being said, we would caution against making major changes to your portfolio unless dictated by your financial planning needs. Instead, we would recommend focusing on what really matters. We appreciate you watching this video, and please don't hesitate to reach out with any questions.